Investing is a game of pattern recognition, and sometimes we come across situations where we say to ourselves, I've seen this movie before, I think I know how it ends. And obviously there's no guarantee it actually goes the way we like it to go, but we believe the odds are in our favor, and that's the reason why we invest. When I came across the stock I'm going to pitch you today, I saw the following setup: a company with two operating segments, one of higher quality than the other, a new management team that just came in, it had worked together before and is incentivized to drive the stock price higher, and is willing to sell the lower quality business and reinvest the money into the higher quality business. For some of you, that may sound like innovative food holdings, but I'm not going to pitch it today. Sorry, Bill. And as a matter of fact, the stock I'm pitching today is Ascent Industries. Disclaimer, I own the stock and it's not investment advice. Please do your own due diligence. So let's break down the thesis. I already touched on some of the parts. Historically, Ascent Industries was basically or mainly a steel business. I think they had 4 steel subsidiaries and 2 facilities in the specialty chemical industry. Within the last years, they basically shut down or sold almost all of their steel subsidiaries. Recently, they sold one of the last 2 remaining ones for 45 million in cash. I believe the second and last subsidiary is to follow, that they will also sell this one. The remaining company is a specialty chemical company. As I already touched on in my first remarks, Brian and Ryan, who are the CEO and CFO of the company, have worked before in the specialty chemical industry together, and they already drove gross margin improvements. I will touch on that later. So what we are seeing right now after the sale of one of the 2 remaining steel subsidiaries, the company has half of its market cap in cash, and I think trades at roughly 8 times EV to EBITDA on depressed earnings. So what do they actually do? As I already touched on, the main thesis or main remaining part of the business is the specialty chemical business. And they have 3 production facilities all across the US. They kind of, you can think about it that the specialty chemical is split up into 2 main product lines. One being custom manufacturing, where they either manufacture chemicals for either the end users or other chemical companies which are looking to outsource actually their capex to them. And also their branded products, which they are just focusing more on. So I will touch on that later, but these branded products have higher gross margin, and that's part of the thesis. So the custom manufacturing enjoys usually long-lasting relationships with their users, with their customers. And obviously, as may some of you know, the chemical industry currently is in a soft spot since the destocking trends after COVID. So the tubular segment, the steel segment, I will just briefly touch on it because going forward, I think it will not play a huge role other than generating cash by selling off the remaining asset there. Here's an overview over the transaction, which they just announced. As you can see, the remaining business, the ASTI business, did 27 million in revenue in 2024. I do believe that this remaining business is a bit more specialized than the one they just got sold. So I don't know, maybe it's worth 20 million, so you could potentially generate further 20 million by selling off this steel subsidiary. And if you look at the bottom right, you actually see the evolution of the revenue from the steel business decreasing further and further, which is basically the main part of this thesis. So this is probably my favorite slide to show you the progress the management team has already achieved so far. I think they took the helm at Q4 2023, and this is only the specialty chemical business we are looking at. So if you look at the whole company, basically right now it makes no sense because the numbers still include obviously the steel business, which again going forward will not play a huge role. And you can clearly see the gross margin improvements sequentially quarter over quarter. And what is really impressive to me, and I will show that on the later slide if you put that into context, on this lower revenue, or despite lower revenues, which to some extent have been self-inflicted because they just focused on higher higher earnings, higher gross margin contracts, and obviously because the chemical market is still soft. But despite these lower revenues, again, the gross margin was actually at an all-time high. So if we see the specialty chemical in a historical perspective, we see that the gross margin kind of was the highest in 2020, achieving 15%. And now in 2024, if we just look at Q4, I think they were close to 20%, which is quite remarkable. If you just wonder why there's a huge jump in revenue from 2021 to 2022, it was due to an acquisition in the specialty chemical business. So now coming into valuation. As I said, right now, I think the stock price barely moved since then. I think it's at 12.80, so these numbers are still fairly accurate. After the recent announced sale, you have they had, I think, 18 million before in cash. Add to that the 45 million, so around 63 million net cash, meaning the enterprise value goes down to 65 million. And I do believe in this current depressed chemical markets, they are able to achieve 8 million EBITDA, which would put the stock at 8 times EBIT to EBITDA. And if we would assume a further sell of, say, 20 million, then obviously the enterprise value would further decrease. Now, what is really important here to notice is that you come around these pitches, which obviously take the enterprise value, which take the cash out of the value equation. But if nothing happens with the cash, if the cash just sits on the balance sheet, then you really don't have anything to buy, not any advantage by that. But they're looking to buy specialty chemical to do companies to do tuck-in acquisitions for 6 to 8 times EBITDA. So in theory, they could buy another 9 million of EBITDA with the cash they have. So what are the catalysts going forward? Shift towards branded products. For reference, currently as of 2024, I think it made up around 25% of revenues. Historically, it has been below 10%. Management is looking to increase that to 40%, which again has higher gross margin than the custom manufacturing. We have this, I believe, the second sale and last remaining sale of the tubular business, which would increase the cash position further. Obviously, at some point, the chemical industry should recover. I don't know when that will be the case. An acquisition of another chemical business, and they're also looking to buy back their shares with the cash they have off the balance sheet, which can provide a further catalyst. Well, basically everything I just laid out as catalysts can also be a risk, such as a bad acquisition or the shift towards branded products may not be as successful as planned, and obviously the chemical market can remain depressed for a longer period. So that's basically my pitch. If you have any questions, feel free to ask me or also the management team, which is also presenting here.
We have time for a question.
Anybody have a question? Just raise your hand.
Has the company ever bought back shares in the past?
Yeah, I believe they bought back last year, I think 1 million worth of shares, but I'm not exactly sure about the number, but yet they have. Tariffs? Yeah, I imagine this question would come up, so I didn't include it. So I asked the management, I think, so yeah, tariff risks. So I think 95% of the raw materials are sourced within the United States, and there is even a potential chance that this company is a tariff beneficiary, since it's a made in the US company. They have 3 production facilities in the US. So if you look at the amount of chemicals that actually get imported into the US, I believe from China or from Germany, other companies, you could assume that some of these companies that buy these chemicals are looking to not import them, but actually buy from an American company instead to avoid tariffs. He was asking about basically if the environmental regulations make it hard to compete with the developed world, or developing world, sorry. Good questions. Honestly, I don't know, to be frank with you. Yeah, I just assume that, as I said, now with tariffs, that could obviously be a factor in that, which I guess is kind of hoping the administration to do. If that plays out the way it does, I don't know, but the custom manufacturing are usually long-term relationships with the clients, so these are really long-standing relationships over years, so I don't expect that to be kind of at risk. For the branded product, that's why I included as a risk. You obviously have to compete with other companies. That's certainly the case. I don't know about the international versus national competition, but again, with the current environment, I do believe that kind of at least incentivizes the companies to maybe look into buying more of the US chemicals than outside.